The stock market is one of those topics that can feel intimidating, confusing, and even a little scary, especially if you're just starting out. Words like bull market, bear market, dividends, and IPO get thrown around everywhere, and it's easy to feel lost. But the truth is, the stock market is not some mysterious magical system reserved for the wealthy or the financial elite. At its core, it's actually quite simple, and understanding the basics can empower you to take control of your financial future. At its most fundamental level, the stock market is a place where people buy and sell ownership in companies. When you buy a stock, you are buying a small piece or share of that company. This means that as the company grows and becomes more valuable, your share increases in value too. If the company pays dividends, you also receive a portion of the company's profits. In other words, owning a stock gives you the opportunity to participate in the growth and success of businesses around the world. Let's take a real example. Imagine you buy a single share of a popular tech company for $100. Over the next year, the company releases innovative products, grows its revenue, and increases its overall value. The price of your stock rises to $150. That $50 increase represents your profit, often called a capital gain. If the company also distributes a small dividend of $2, you receive that money in addition to the gain in the stock price. Suddenly, you're making money from both the growth of the company and your investment in it. That's the fundamental idea behind the stock market: buying pieces of businesses and watching them grow. The stock market exists in part to help companies raise money. When a business wants to expand, develop new products, hire more employees, or enter new markets, it may sell shares of stock to the public. This process is called an initial public offering, or IPO. Investors buy these shares, providing the company with capital to fund growth. In return, investors get a chance to profit if the company succeeds. This is why the stock market is often described as a bridge between businesses seeking capital and individuals looking to invest. Now, the stock market can be divided into different types of markets and exchanges. The most famous in the United States are the New York Stock Exchange. The NYSE is known for housing some of the largest and most established companies in the world, while the NASDAQ is famous for tech companies and innovation-driven businesses. Regardless of where you trade, the principles remain the same. You buy shares at one price, and your goal is for the value to increase over time. It's important to understand that stock prices do not move randomly. Prices fluctuate based on supply and demand, which is influenced by countless factors. Company earnings, industry trends, economic conditions, and even global events can impact how investors perceive the value of a stock. For example, if a company reports higher than expected profits, more investors may want to buy its stock, driving the price up. Conversely, bad news or disappointing results can lead to selling, causing the stock price to fall. Learning to understand these forces and observing patterns over time is what many successful investors do to make informed decisions. One concept beginners often struggle with is risk. Investing in stocks is not a guaranteed way to make money. Prices go up and down, sometimes dramatically. A company that seems unstoppable today could face challenges tomorrow. But risk is not inherently bad. It's simply the potential for both gains and losses. The key is to manage risk intelligently. Diversification, which means spreading your investments across multiple companies and industries, helps reduce the impact of any single loss. By not putting all your money into one stock, you protect yourself from major setbacks and increase your chances of steady growth over time. Another important principle is the difference between short-term trading and long-term investing. Many people get caught up in trying to predict the next big price movement and end up making impulsive decisions. While trading can be profitable, it's also risky and requires deep knowledge, constant attention, and sometimes a bit of luck. Long-term investing, on the other hand, is about buying stocks in solid companies and holding them for years, even decades. Historically, the stock market has grown over the long term, rewarding patient investors who avoid panic selling during downturns. Think of it as planting a tree. The earlier you plant, the longer it has to grow, and the bigger the reward in the end. It's also worth mentioning dividends, which are another way the stock market can reward you. Dividends are portions of a company's profits paid out to shareholders. Some companies, especially well-established ones, Pay regular dividends, providing investors with consistent income in addition to potential stock price growth. Over time, reinvesting these dividends can significantly increase your wealth. It's a powerful example of how the stock market offers multiple paths to financial growth. Technology has made investing more accessible than ever. Today, beginners can open accounts on online platforms, buy fractional shares, and even automate investments. You don't need millions to get started. With a small initial investment and consistent contributions over time, anyone can begin participating in the stock market. The challenge is not access, it's education and discipline. Understanding the basics, like how the market works, what drives prices, and how to manage risk, is far more valuable than reacting to every headline or rumor. Many people also worry about market crashes. The stock market has experienced downturns, sometimes severe ones, like the 2008 financial crisis or the 2020 pandemic-induced sell-off. These events can be scary, but they are also part of the natural cycle of investing. Prices go up and down. Smart investors view these times as opportunities rather than threats. Buying quality stocks at discounted prices during market dips can lead to long-term gains that far outweigh temporary losses. The key is to stay informed, avoid panic, and focus on the long-term picture. One final concept beginners should understand is the power of compounding. When your investments earn returns and you reinvest those returns, your money grows exponentially over time. This is why starting early is so important. Even small amounts invested regularly can grow into substantial wealth decades later. The stock market rewards patience and consistency, not impulsive decisions or quick fixes. By thinking long-term, understanding risk, and investing wisely, even beginners can participate in wealth-building strategies used by seasoned investors. In conclusion, the stock market is not some mystical or intimidating place. It is simply a marketplace where people buy and sell ownership in companies. It offers opportunities for growth, income, and long-term wealth creation. Understanding the basics, how stocks work, why prices change, what risk means, and how to invest intelligently, gives you the tools to participate confidently. Like any skill, it takes time to learn and experience to master, but anyone can start today. By focusing on education, patience, and long-term strategies, the stock market can become one of the most powerful tools for financial growth in your life. If you want to build wealth, create financial freedom, and understand how money works in the modern world, the stock market is a place you cannot ignore. Take the first step today. Start small, learn consistently, and watch how knowledge combined with disciplined investing can transform your future. Don't forget to subscribe to the channel for more practical finance lessons, tips for beginners, and real-life examples that make complicated topics simple and actionable. Your financial future is in your hands, and the journey begins with understanding.